Modern portfolio theory tells us to diversify our investments to minimize the risk exposure. Don't put all your eggs in one basket is the most common phrase being used. However, legend investor Warren Buffett also said, diversification does not make any sense if a person knows what he's doing. Which advice should we follow when investing our hard-earned money? Let's first look at why you should diversify your portfolio. To understand this, let's introduce the concept of expected return E and standard deviation sigma. The expected return is the weighted average of all possible outcomes from an investment, and the standard deviation is the measurement of volatility or risk. We will use an example below to demonstrate the more diversified you are, the less risk you have while maintaining the same level of expected return. Let's first introduce the game of flipping a coin. You all know that there's a 50-50 chance of a head or tail. You need to put down whatever amount you like to play this game. For example, $1. Let's assume you'll get 3 times of your investment back if you get a head, which is $3 back with a return of investment of 200%, and lose everything if you get tail. The return of investment is negative 100%. In this scenario, your expected return E is the sum of return of investment multiplied by their probability, and standard deviation equals 150%. Although it's a very rewarding game, but since the single game has a high probability of 50% of losing everything, it is very risky. Your instinct may tell you that you should not play the game if you have to put all your money in it. However, you can reduce the risk significantly by splitting your investment by half. Let's assume you play this game twice in parallel, which they are independent, and each game using half of your total asset. We will get 4 scenarios like below. Either you win both games, or you win and lose one game each, or you lose both games. The expected return will be return of investment in each scenario times their probability, and sum up to be 50%, which is the same as we had before. But you can see the standard deviation will be much lower at 106%. And in fact, the smaller you bet every time and the more you bet in parallel, which still assuming all investments are totally independent, you will be able to minimize your risk and maintain the same level of return. There's a limit, however, that you will never be able to reduce your standard deviation or risk to 0. What's remaining is called the systematic risk, at which point there's no way to further reduce the risk by diversification. Plot the number of times you flip the coin and your standard deviation on the plot below. You can see that by increasing the number of assets, greatly reduce your portfolio risk closer and closer to the systematic risk. The interesting thing of modern portfolio theory is that it helps calculate the optimum risk and reward level for your portfolio. For a combination of investments or portfolio, there's expected return and risk. Risk is measured in standard deviation, similar to the coin flipping exercise we've shown earlier. An undiversified portfolio may have a very high risk, comparing to a more diversified portfolio which could have the same level of return but much lower risk. We can draw out all possible investment combinations on a risk and reward plot. Each dot represents an investment combination, a portfolio. Take portfolio A for example. The expected return and level of risk can be found by drawing a vertical line and its intersection with each axis. Using this graph, it is easy to see that portfolio A is not optimized. You can find portfolio B give you the same level of risk and much higher expected return, and portfolio C would have the same level of expected return and much lower risk. If you draw a line across all the best possible investment portfolio, you will get a curve which is called the mean efficiency frontier. Portfolios that lie below the efficiency frontier are suboptimal because they either do not provide enough return for the level of risk, or they have a higher level of risk for the defined rate of return. Diversification seems essential under the modern portfolio theory. It seems perfectly explained why we need to diversify our portfolio to optimize the risk and the reward level, and aligned with the traditional wisdom of don't put all your eggs in one basket. But wait a second, here's what Warren Buffett claims.
We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. They Diversification is a protection against ignorance.
Why would the most successful investor in history go against diversification? Let's first look at a few limitations of the modern portfolio theory. First, unlike coin flipping exercise, the expected return and risk is much more difficult to calculate in the real world. Take a company's stock, for example. The closest data you can get will be from the financial report is published for the previous year. The most commonly used valuation is the PE ratio, or the price to earning ratio. You can understand it as how many years it takes to double your initial investment. You may also look at the past few years of the financial report to see how much volatility or risk this company have. However, all financial reports are past data and do not necessarily represent an accurate picture of how the company is performing now. On top of that, financial report and profit and loss can be altered greatly using a different accounting standard. It is easy to be misled by such information published by the company, and some companies may even go too far. And think about the recent speculation on Wirecard, which is missing €2 billion. The second reason modern portfolio theory is difficult to apply, it is difficult to adapt to its change. Think about two companies that having the same level of return and risk on the current year. Company A is in a declining industry and struggle to maintain the same level of revenue and profit in the coming years, and Company B is rising quickly and both revenue and profit is expected to grow double-digit for the coming years. Their valuation might be very different. Company B will get valued at much higher and hence rejected by the modern portfolio theory, but it may still be a better investment opportunity based on the future growth. The efficiency frontier do not provide a good answer of how to diversify investment in such a scenario. The third and most important reason is what mentioned by Warren Buffett.
If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood, and to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness.
If you're trying to balance your high-risk, high-return investment with your low-risk, low-return investment, mean efficiency frontier can help calculate the optimum ratio. However, there ain't that many great business in the world, and you may find one stock have both higher return and lower risk comparing to other ones with lower return and higher risk. You should put all your money in the first one instead of diversify your portfolio for the purpose of doing it. If you found the golden basket, why not put all your eggs in there? Is diversification useless at all? Not really. The first and most important lesson you should learn is that do not risk what you cannot lose. Think about the worst case scenario and the impact to your portfolio. If you cannot take it, you should diversify a bit more. There's an equation to calculate the optimum percentage of your investment you can put to one opportunity based on its risk and reward. And to learn more, there's a link below for more information on Kelly criteria. Secondly, accept what you don't know and focus on what you do know. Know what you don't know is sometimes more important than what you do know. Warren Buffett said diversification means you don't know the business, then accept that you don't know the business. If you only know the IT sector is going to grow but you don't know the pros and cons between Google and Facebook, diversify your portfolio and invest evenly across the sector. In this case, you'll not be impacted by the rise and falls of individual stocks and the information that you don't know, but focus on what you do know and benefit from the growth of the whole sector. Finally, understand your own preference. We are human beings and not machines. The first ice cream is much better than the second one, and the first 10K you earned have a very different meaning to you comparing the 10th 10K. Psychologically, we all experience the diminishing marginal utility. Higher return do not always bring you more satisfaction if you don't like the risk with it. Ask yourself what's your risk preference and adjust your portfolio accordingly. This will be the best way to be rational and keep making good decisions. That's the end of this video. If you learned something, please hit the like button below and I hope you enjoyed this video.